Well, g'day there, traders and friends, market participants, and enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I bring you this midday market update as at Tuesday, the 28th of March, 2017. It's very important. This is going to be a continuance off from the video which I uploaded over the weekend. In that video, right, just to go through some of the main points and themes we were talking about, or at least addressing the fact that this rising 50-day exponential moving average was going to be acting like a magnet short-term for price. Fast forward through Monday's trading session, we gapped down more or less right on that 50-day exponential moving average. We saw the market push down below it temporarily throughout the trading session. However, as expected, we saw the dip buyers show back up and begin purchasing the market. As you can see, right up until, of course, where we find ourselves midday on Tuesday, the market continues to propel itself, albeit short-term, off this 50-day exponential moving average, as you can see. Now, again, on the S&P 500, you can see the gap down. We actually gap below that rising 50 EMA, but you can see, once again, the transition, which is taking place from Monday right through to this video recording on Tuesday. The NASDAQ fell a little bit short of that rising 50. It didn't actually gap down to it, nor did it gap down really below it, but you can see, again, we got somewhat close to it. But again, the same sentiment is taking place on the NASDAQ. So we can say that collectively across the board, the markets are more or less moving in agreement. Now, really just to refocus on that previous video, we were addressing the fact that once again, the market should pull back down to the 50. It was acting as a magnet. And then obviously the question came, well, what happens when we hit that 50? And I proposed to you over the weekend that we were going to see a very quick and very sharp and albeit a very abrupt rally to the upside. Now, again, as at Tuesday, we're beginning to see, I guess, the inklings of that snapback rally to the upside. And really what you should be focusing on at this particular juncture is, well, what happens across the board? That's meant to be a question mark. What happens across the board on these equity markets when we see the Dow Jones Industrial Average come back up and hit roughly 21,000? This is essentially the line in the sand. This is the pivot point resistance area where the market itself is either going to break up above and continue the long term, both the macro and the intermediate trend, or we're going to see some form of an inflection point on this market. And what I mean by inflection point at this particular time is, well, if we come back up roughly to this area, again in the vicinity of 21,000, it might be a little bit higher up to 21,200, give or take a couple of hundred points. But again, roughly around this area up here, if we begin to fail, turn back down, then we're really going to establish once again some of these divergences, which are very pronounced across the board on these equity markets. Pay attention to the higher high between December and where we are in the month of February and March. Again, if we go out onto bigger fractals on the weekly timeframes, again across the board, we're registering, weekly sell signals. Now, towards the end of intermediate moves and also macro moves on financial markets, oftentimes what we'll see is, again, we'll see the market come back down to that rising 50 exponential moving average. Again, a lot of active market participants will jump back in, even in the face of divergence and again, a lack of commitment or momentum, and they will try and capture the buy the dip opportunity in the, I guess, the assumption or the speculation that the market itself is going to break out above this resistance area. That's why this line, which I'm drawing on my screen, is very much so critical to, I guess, the intermediate and even potentially the macro health of this uptrend which we find ourselves in. Now, at this particular point in time, I'm not going out on a limb and calling this some form of an intermediate top. That will be assessed once we get above, or at least get back up into these swing highs. And then, of course, we'll start approaching this market as neutrally as possible. What I can say at this particular point is that we have put in some minor structural lows, which is very important, because really when we talk about technical analysis, it's really built on the foundation of confirmation of bullish trades, and of course, confirmation of bearish trades. Once we see price action move above and below certain pivot points or pressure points, right? Sort of interconnected or interrelated in many instances. And really it is just the study of sentiment. It's a sort of, in many ways, the understanding of psychology and the way emotionally driven, or at least how market participants are emotionally driven. So now that we have this little low, which again sort of establishes itself around that 50 exponential moving average, we can start saying to ourselves, well, if we get the bounce and if we come back up to roughly 2380, all the way up to 2,400 on the S&P 500, if we break above the swing high, that's great. That's fantastic. We would expect the intermediate and the macro trend to continue. But if we get back up into this point and we start to fail, this lower swing low over here, which we've established on Monday again, which is sort of interconnected obviously with that rising 50-day exponential moving average, this is going to be the swing low pressure point. So what we can say and begin formulating, or at least coming to in terms of trade analysis and trade opportunity, for exposure on the S&P 500, and again, you can apply this to the Dow and the NASDAQ as well, is that we're starting to range, or at least bracket trade, so to speak, the markets. We've got the breakout continuation bullish trigger, but at the same time, now that we have this lower wick and obviously the little reversal which has taken place towards the end of March, or at least in the final trading week of March 2017, we can understand that, again, that inflection point, if pressed, will crack once we start pushing below this lower wick over here. Now, again, I'm not calling for this to happen, but again, I'm just walking through the psychology and the sentiment, trying to at least register this to you so that you can understand how we can really formulate some great trade opportunities and at least allocate capital smarter to either market exposure or how that fits into the puzzle of individual trade analysis also. And really, this is a fantastic segue into some of the trades which we spoke about over the weekend, and really essentially sitting on our hands and waiting for better opportunity, or at least in essence, the confirmation of either that market breakout or that market reversal to take place in due course. Because again, this is across the board. You can see that lower reversal which has taken place, that subsequent lower low, and the reversal which is taking place between Monday and Tuesday. This isn't unexpected, and it is largely predictable. At least you can forecast it once you become, again, proficient in technical analysis. You can see the same thing is happening in the NASDAQ. Now, this is obviously leading somewhere. And this is where I'm, this is obviously where I'm taking this discussion right now that I have your attention. Over the weekend in Pro, we were looking at a bunch of individual trades, and really the premise that we came to, or at least the narrative or the forecast, was the trades are brewing, they're coming, however, they're not ready yet. And really, the reason we came to that conclusion was because of our understanding of the way the market itself was structurally based. Now, again, I've sort of walked through that for you during the first sort of period of this particular intraday market update. And really what I was, again, addressing was the simple fact that we generally bounce off from that rising 50 exponential moving average. And it wasn't a good opportunity to start looking at bearish orientated trades, nor was it a good idea to be jumping into a bunch of bullish trades depending on your fractal which you trade on, because again, we don't have confirmation of the market breaking out above, or at least simultaneously in agreement, in congruence, breaking out above the resistance swing highs. So now if we fast forward this, and again, understanding that we're coming back up into that resistance area, you can see how a lot of individual trades have actually pushed below. They've established subsequent lower lows, but at the same time, we were talking about just how oversold they were. And again, in context of the market, how we expect a lot of these individual companies to head fake. And unfortunately, whipsaw a lot of novice or beginner traders who are looking at the picture and saying, well, this is quite bearish. Let me jump on board and start maybe executing, or at least purchasing some put contracts or selling short a bunch of stocks. And it really was the explanation as to why that is, again, rather risky at this particular point. The reason being that the market hasn't confirmed any form of a material pullback or material reversal based on confirmation. So as you can see, just to go through a couple of stocks, we've got COP, which again has produced that head fake, a head fake which we've been waiting for, much like the US dollar, which is taking place right now. Pardon me, I'm just clearing my throat. If I continue just showing you a couple of other charts as well, and again, you can see the dotted lines on my screen. This is this is a major warning as to why I'm not doing something, by the way. CVX has done the same thing. It's printed just below the structural support. A lot of novice traders, once again, are looking at this and saying, well, if we start breaking this level over here, I'll start shorting this particular stock. But at the same time, they're not understanding how markets, or how long it takes for markets to structurally change before they offer the right opportunity to begin opening up exposure, even at higher prices. So as you can see, CVX, a lot of people having to unwind that initial short, and you can see the snapback rally taking place up over $1 through to, of course, about the mid session, or here we find ourselves pretty much in the middle of today's trading session. Again, if I fast forward into Goldman Sachs, you can see the same type of candlestick arrangement over here. You got the intraday push on Monday and the snapback taking place on Tuesday. So again, it isn't all that surprising to see these types of advancements in the financial markets. If we also show the Russell 2000, we spoke about this in great detail over the weekend. Again, just going through some of these major divergences taking place. However, also talking through the sentiment and how these things generally work out. Again, snapping back from a general oversold vicinity. It looks as though we're establishing some form of a bear flag. The same is true for the Russell as it is for the other three equity markets that have already moved through. What we're beginning to establish right now is that tradable structure. So right now we've got that swing low. Again, we're not in any Russell puts, even though the line is solid. That obviously I spoke through over the weekend with the dotted line. And again, the same cautionary approach which has been applicable to the other equity markets which I've already covered. But again, just to show you this as we continue, if I bring up the Dow Jones Transportational Average, pardon me as well, you can see that same type of structure. We can all identify, of course, what's going on here. It does look like some form of a triple top or even potentially head and shoulders type of pattern. But again, when we start looking at divergences, this is the most important picture of them all. What we've done is we've established multiple swing highs, or at least a continuation in terms of price action, establishing higher highs. With these three peaks, one in December, one towards late January, and then again early in March. Again, this is setting the tone for potentially something a little bit more sinister. If you pay attention to the MACD, you can see obviously this divergence taking place. However, again, it sort of it whipsaws a lot of people who want to jump in a little bit too prematurely. You really need to wait for the markets to really set up to where you can formally execute a trade. Given the right time and the timing of the market itself. We've got this short-term temporary breakdown. Structurally, this is quite a negative thing for the market. However, we have been expecting this bounce. The bounce is taking place right now, but again, we have to monitor what happens across, again, all of these financial markets and to really unlock this sentiment, because if we do not break out to a subsequent higher high, and if we don't really negate a lot of this divergence taking place, not only on the daily time frame, but also on the monthly time frame, which is rather interesting as well. Time frames which we just generally haven't seen divergence set up. Again, you can see this higher high, for instance, on the transportational average. This is on a monthly chart beginning 2015, and you can see again with the MACD. I mean, it's very pronounced, it's very prominent, and unfortunately, a lot of people are simply not going to see this reversal when it eventually sets up. And for divergence to be to become defunct on the monthly chart, it's really going to take a number of years for that momentum to flow back into the market. So what has been an aggressive start towards the end of 2016 into the beginning of 2017, although people are really championing the momentum and the velocity and the aggressive parabolic rise of this market, on the monthly time frame, it still really hasn't done all that much to offset. It hasn't really done anything whatsoever to offset a lot of these major macro divergences, which are taking place, unfortunately, across the board. And generally what happens is eventually they will lead to some form of a terminal reversal pattern. But going back down more so into the molecular level again, we're expecting the bounce. That bounce is either going to produce the continuation of the bullish trend, which would be a good outcome, obviously, for the market, or it's going to set up potentially that lower high, which is going to become awfully problematic moving forward. Now, to sort of round out this rather brief discussion, we're looking at the US dollar. The US dollar is down at the bottom of my green box here. So we are at the precipice, or we are at the very end of support, and I assume support is going to hold. Again, this is an extension of a trend line beginning around mid-2016, and you can see how many touches we have had on this extension, or at least on this trend line. That is a projection into the future. We're starting to sort of interact with that now. Also, it sort of X marks the spot, because, I mean, that was an absolutely horrible illustration. But if I zoom back in, I mean, we've got this rough support area coupled with, of course, this rising bullish trend line. So again, I'm rather bullish on the US dollar until, of course, we break this green box and we also break this trend line over here. That's why I've got the bearish entry at 97.82. However, I do expect this 101.47 entry to trigger once, of course, we hold this support and we start to see these oscillators turn up. As you can see, they are relatively oversold. It fits the criteria, being at that sort of extension of momentum, coupled with extremely strong macro support. Sentiment at the moment is relatively bearish on the US dollar, and it fits the profile or the inklings for that sort of reversal to take place right at this particular pivot point. So pay attention to the US dollar. If you start to see subsequent strength or inflows into the US dollar begin occurring, or to start to see price action turn favorable, and to begin to see the construction of a multiple of bullish candlesticks, you'll understand, or at least you can at least expect, for the US dollar to continue to appreciate in value. And again, if I just look at this on the weekly chart, or maybe I'll zoom out to the monthly chart just to put this in perspective for you. Again, we have to go out quite a long distance to see just how, at least in terms of targets, just how high these targets can be. This is going back really to 1985, and you can see that we've got this very large downward channel taking place on the US dollar. The last time we oscillated back up to the top of this channel, interestingly enough, was towards the end of the dot-com bubble, where again the markets peaked out in 99 and also 2000. So the US dollar, and I guess that projection right now, it's coming in at about 112.92. So here we are, we're sitting very close to 100 on the nose. So we've got about 12% from current levels, in my opinion, my personal analysis, as to where I believe the US dollar is going to sort of gravitate and move towards, just like the magnet short term on the equity markets being that 50 exponential moving average, or the long-term macro picture for the US dollar for me technically is up at around 112, which again is about a 12% appreciation in price for the actual currency itself, which is a tremendously large move and gives us a lot of opportunity in the forex markets to take advantage of something like that. And again, this is where the beginning of that move is going to start. Makes a lot of sense. So I'm keeping my eyes very much closely sort of positioned on the advancements and the continuance of the trading which is taking place on the US dollar at this particular juncture. So I hope that has helped you throughout, or at least up until this point on Tuesday. Obviously, the markets are going to change throughout the trading session, but again, this is just a snapshot. As at the 28th, if you find this analysis interesting, I'd encourage you to have a look into Pro. It's a class I do over the weekend, and we start looking at this, or at least we go into this analysis in much more detail. And again, we get a very good outlook for individual trade analysis moving forward, which is very important and the major reason why people attend that class. So on that note, everybody, have an enjoyable remainder of your Tuesday or a Wednesday, depending on where you are located around the world. It's James signing off on behalf of Pivot Point Trading. All the best, everyone. Goodbye.